What is going on, everybody? Welcome to the Investing Bros live coverage of the FOMC rate decision and the press briefing from none other than Jerome Powell. We'll be hearing from him in just a few minutes. At 2:30 Eastern Standard Time is when Jerome is scheduled to go live. Am I doing it alone? Of course not. I've got trusty Army Piper right here with me. Army, how you doing?
Brother, I'm doing better than you deserve.
I love it. I love it. Well, thank you guys for tuning in. I know there's a lot of streams right now that are live for this very, very topic, this very exciting topic. And you guys could have chosen any one of those. And we thank you so much for tuning in to the Investing Bros coverage. Army has been working tirelessly to get a really good visual for you guys of a couple of different asset classes that we will be watching the volatile reactions of here in just a little more than 2 minutes. We'll be seeing the rate decision, and then of course the press briefing will also bring some more volatility. We previewed the heck out of the FOMC meeting already last week and in today's live stream. So I mean, ultimately, if we get anything other than a 25 basis point hike, expect extreme volatility in the markets because there'll be a repricing of almost every single asset class, which means that the 25 basis point hike is baked into Bitcoin, gold, the S&P, the Treasury notes. So anything other than a 25 would be pretty crazy, to put it bluntly. And we're going to be getting
Absolutely
that here in a little less than 1 minute. So Piper, what are you looking for in this rate hike? Is there anything? Is there a chance? What do you? I mean, it's 12% is what the CME was giving it. That it would be a pause.
Yep.
Do you think that that's likely at any point in this?
No, I think I'm at this point, I'm all in on 25 basis points. I think that's what we're going to see. But I do believe that when he comes out to speak, he's going to talk very devishly about slowing down the rate hikes in the future. And I think that is going to give us a nice little rally up and hit. We are about 2 minutes away. I'm still watching the charts over here. So as soon as this Fed interest rate hits, I'm going to be dropping it up here on screen. We'll watch that in real time, and then we'll talk about that while we pull some charts up here and see what it's looking like for us. Looking on the thing there. Someone said, "Did we lose them? Did you guys lose us?" I don't think we did. I think we're good.
Yeah, I think we're good too.
Yeah, I think we are.
If you're in the chat, just let us know if there's any kind of.
Yeah, we're good here. Yeah, just need to, Mr. J, you need to reconnect your YouTube. We are live on there. I'm looking at us right now on the screen. So no, we're good here. We're about 1 minute out from this data. I'm going to go ahead and pull over my screen here. And there we go. We got this moving now. So yeah, let's see how this looks. Looks like it's going to be coming in the next 30 seconds or so. So can't be mad about that.
I'm refreshing the federalreserve.gov page because it's theoretically where it's supposed to print first. So I'll have the readouts here, but I believe Trading Economics does print it in real time as well. So
yeah, they do.
And of course, we'll open up kind of.
It's loading in right now as we speak.
Yep. 2:00.
Ah, there it is. 25 basis points, guys. 25 basis points. So now let's go over and take a look at the chart. T-Shroom, I'm going to bring you in here while we watch this. Just give me 1 second, and I'm going to drop you in on the charts here with me. This is going to be interesting to do. Yep. I'm going to go ahead and throw on T-Shroom in here in real time. You guys get to see all this come together.
Yep. So the SPY and the NASDAQ are all green, up 0.5% respectively. The Dow Jones is up 0.2 green. The Ethereum is green. It's up 0.5%, and Bitcoin is down 0.5% on the news so far. I'm not really seeing too much repricing going on. Lido is down 5%. That's the most in one direction that I'm seeing. All of your big your mega cap tech stock names are up markedly. Amazon up 1.2%, Tesla up 2.6. Um, yeah, your bond yields are down. The 5 years down 2%, and your 2-year treasury is actually down below 4% here. So that is significant. You still have a inverted yield curve across the board, but that is theoretically moving in the right direction. Take a look at your chart breakdown, Piper, and tell us what you're seeing.
Absolutely. So jumping over here, yeah, looking right now, it looks like Bitcoin. So on this chart here, guys, I've got my little four screener here. Let me put this on Dixie real fast so I can have that. There we go. Come on, change it to Dixie. I know you don't like the Dixie either, Trading View, but it's okay. Yeah, Dixie's dumping right now. These are 1 hour charts that I'm watching. Let me go ahead and drop these into a lower time frame so you can really see this volatility in real time.
Oh man.
Uh,
Oh
yeah,
man.
yeah, the Dixie's dumping hard right now. But Bitcoin not really getting much action right here, right there by your face. T-stream right there. See that
Yeah.
right there? That's
Yeah.
Bitcoin. Not really getting much action there on that one. So guys, reminder, we are going to be showing the speech. The speech is where everything's going to be at. This is the volatility I talked about. I said things can get really, really crazy for about a half an hour, and then it gets even crazier. So that's how that works, man.
Yeah. And I don't think we're in the outro quite yet. There you go. You got it right as I was saying it. I'd just give you a couple extra seconds, you would have gotten it. But yeah, the Dixie is definitely is the biggest mover right now as a reaction to
Yep.
this print of 25 basis points. Again, everything was pretty much priced in. So why are we seeing the Dixie move? Do you think? Well, why wasn't this priced in? Why is there so much movement and volatility in the dollar?
Because everyone right now didn't see 50 basis points. It is a 25 basis point, which was already cooked in, and so the Dixie is just kind of rejecting off of that news because people are looking at risk assets right now, or they're pulling out because they think that this is a sign that he's going to get even more hawkish here in a bit. So,
Mhm.
I what the mentality of most of these investors is when it comes to the Dixie and TradFi. It, flip a coin, put a bunch of reasons on the wall, close your eyes, and throw a dart. That's probably
Mhm.
what we'll go with for the day. So,
Yeah.
um,
Yeah, well, I've been on I think I think almost 4 different live shows today, and this is a chart I've been showing everybody. So if you've been following me around the live shows, it'll be the 4th time you've seen this today. But this is a really important chart, guys, because if you ask the question, are we in a financial crisis? Are we in a banking crisis? The answer is found in this chart. I'm not going to answer it for you, but you can kind of deduce from looking at this US bank failures in each year adjusted for inflation, guys. We're about to hear Jerome try to step up to home plate with the biggest bat that he can, the Federal Reserve and the printing of dollars, the biggest tools in the monetary playground, and he's going to try and pitch. He's going to try to take a swing at the pitch of this right here of what we're seeing, this giant fastball coming right down the plate of how do you square this that we are now seeing assets under management banks that totaled about the same amount of assets under management banks from '08 in custody now of the government and of course have been resold to JP Morgan. But this is bad. 2023 has been a year almost as bad as 2008. Um, and with some of the newer bank failures that could be right around the corner over here at Pac West, falls more than 20% as regional bank stocks slide to new lows. How much more? How much higher is this going to get? And guys, this isn't from some crazy publication, right? That some dark net or whatever publication. This is from the New York Times. Okay, so they're saying it plainly now. They're not able to hide from this truth here of what this graph is showing. The bank failures are very real right now. In about 15 minutes, we're going to hear. I'm sorry. In about 25 minutes, we're going to hear from Jerome as he tries to take a swing at this giant issue that not just the United States and the West is facing, but the entire world could be in a very fragile state here as we move into the summer of 2023. So, Piper, I'll throw it back over to you. What is this chart telling you, and what should we be buying in this moment? Is there a reason to shift our asset allocations in this very moment at 2:15 Eastern Standard Time, or should we
Absolutely
go ahead
not.
and hold tight and not hit the sell button on anything?
I wouldn't be doing anything until I let the dust settle right now. I had a lot of people asking me in the Chart Prime community yesterday, hey, how do I trade this volatility? And I said, by watching it. That's
Mm-hmm.
what you do. That's how you trade it. You just watch it. Let it settle down a little bit, and then you can get in there. Because he was like, "What if I set a stop loss both way?" I said, "Then both of your stop losses are going to get hit. That's just how it goes."
Mm-hmm.
Um, you're going to get stopped out in both ways, and then it's going to take off the direction that it's going to end up going, and then you're going to be like, "Man, I didn't catch that because I wanted to be in the middle of a stop loss short and a stop loss long, and then both of them got hit." But hey, we got Tim Warren in the house right now, and
Yeah,
he said,
I saw that.
and yeah, Tim Warren is in the chat right now, and he said, "This is all just FOMC volatility and noise." Exactly. That just chill, just enjoy the
Yeah.
show and watch
Mm-hmm.
all of the fun that happens here. So
Yeah.
I'm gonna go ahead and throw it back into my screen here, and we can just watch these charts. I mean,
Yeah.
right now, Bitcoin still, bouncing right here off of its on the 15-minute, mind you, right here on
Mm-hmm.
testing its dynamic reactor. Ethereum actually looking a little bit stronger than Bitcoin right now, oddly enough. But that, yeah, Dixie just getting pummeled right now. Just wicked all the way down to 101. So, and the S&P, uh, it it's creating a doji. We're getting a big doji over here on the S&P. So,
Yeah.
doji candles, that for those that don't know, big wick to the top, big wick to the bottom, kind of looks like a cross. Yeah, that's a doji.
Mm-hmm.
Also, aka the dragonfly. So, um, yeah, let's see. Let's read some chat here, man. What do we got going on in the chat? We got Crypto Archie in the house. Thanks for joining us, brother. Watching the what we call the financial Super Bowl, the FOMC day. Um, we got Eric Wallen in here. He's still saying buy SUI because he bought some this morning and he's trying to keep his bag inflated. So good job on shilling your token there, Eric Wallen.
Mm-hmm.
Gia S said, "Dang, I'm late." Nope, you are just on time, Gia. Whenever you show up is the right time.
When the party's getting
Crypt
started.
That's right. The party don't get started until GS walks in the house. Crypto Trades said, make sure you smash that like button. I agree. I agree with that. Crypto Trades, you are 100% correct. If you guys have not done so yet, we appreciate you joining us. We're going to be going into the live stream here in about 20 minutes, and we're going to be watching Jerome Powell tell us lies. I mean, give us some predictions on the future of what's going on with the
How
Fed
could
and
you,
what we can
Piper?
expecting. Hey, sometimes my inner dialogue filter is broken and then things just come right out. So, but yeah, so we're going to be doing that. Crux of Crypto said, I tried to bet Piper $100 that we would go up a few weeks back, but he rejected the offer. Yeah, of course I did. Because I didn't say it was
Yeah.
impossible. I said it was possibly going to be no rate hike, but I did not say it was impossible to have a rate hike.
Mm-hmm.
He's always trying to bet me. Always trying to bet me, True.
Yeah. All right. Well, Piper, if you'll go over to my screen, we'll go ahead and start our rounds of the different financial media outlets, and see how they're writing their headlines. This is CNBC.com says Fed increases rates a quarter point and signals a potential end to hikes. Okay, so that's how they're wording it. The Wall Street Journal says Fed raising rates by quarter point signals potential pause. So slightly different there. Bloomberg.com says updates on Fed rate decision. Chair Jerome Powell's new conference. Okay, so they're kind of missing the mark here, not really saying anything quite yet. They do have a breaking. U.S. Fed raises U.S. rates by a quarter point, signaling possible pause. So kind of bringing in that Wall Street Journal title there. And then finally, Yahoo Finance says Fed pushes interest rate above 5% and signals it could be done for now. So all kind of resonating with the original kind of one, which is like, the potential into hikes, a potential pause, and then Yahoo saying signals it could be done for now. So very interesting. Here's how we're going to do this, guys. We still have a few more minutes before the press briefing starts. But here's how we'll do this. We will let Jerome Powell start, and we will be pretty silent, and we won't interrupt him unless there's something just completely insane. But so far in the Investing Bros, we've just kind of let him talk, let him run, and we'll voice things in the chat. We may pan over to like a tweet or something, but we're going to be quiet and just let him talk. And then when they start to get into the question and answer stuff, we might start to pipe in a little more. We will not go the full length of the question answers because it goes for a while. You will know. We'll make it clear when we cut off. But just for your reference, kind of how it's going to go. We're just going to let him talk. Say his piece, and just be in awe of the comforting words of our monetary leader. And then we're going to listen to the question and answer session. Thank you, Piper.
You're
And
welcome. I'm
and
here.
then we'll go from there. So that is going to kind of round out our briefing of how this is going to go and kind of what the media is saying. So far, they're all kind of in unison in one chorus saying, hey, this might be the end of the hikes for 2023, which is in agreement with the next CME future tool prediction, which is that in June, right here, I'm refreshing it for you guys. In June, we will be at the same level that we just arrived at less than 12 minutes ago. There's an 86% likelihood that there will be a pause in June. And then, as Tim brought to us our morning show this morning, 9 a.m. weekdays, live on the Investing Bros, Tim brought it to our attention that in September, the majority of those predicting in the CME futures are predicting a cut. So from 50 down to 47, 4.7. So from 5 down to 4.7 to 5. So that's going to be pretty epic. We'll see how the events change those predictions or if they go ahead and stay the same. But we've got about 15 minutes here, Piper. What are some things that are on your mind as we go into Jerome's briefing, his conference here? What are you looking for him not to say? What are you looking for him to say?
So I'm going to be watching. I do believe that he's going to give some foreshadowing that we're going to have a pause next cycle, next FOMC. And the reason for that being is because I think O Man 13 here said it best. He said, let's increase rates to wreck more banks so that we have to print more money and raise inflation. So, printing money bails out banks. And right now, that's what we're seeing. These banks are getting crushed. Raising these rates is going to make people less likely to go in and take out a loan. And banks don't make money off of anything but those loans, right? That's what they do. They take your money and then they loan it out 15 times to 15 other people, and it's all on paper, thereby printing money. But yeah, it's that's what's going to happen. This is going to make people even less likely. If you were thinking about buying a house and you were holding off on rates, you definitely are not buying a house now. So, yeah, chain link. I like the chain link hat. Um,
Yeah, you gotta love it.
but
Well,
yeah,
if you go back, if you'll, so that is definitely what I'm looking for as well. Taking a look back over at my screen, we've got the red words. I believe CNN does this, or somebody does. I'm sure a lot of different outlets do this now, but this is the change from the last FOMC statement. These are statements that are issued. This is the what it looks like on the .gov website right now, and then this is what has been changed. So what is crossed out is what is on the previous briefing, on the previous statement, and what is underlined in red is what has been added. I'm going to read what has been added. So economic activity expanded at a modest pace in the first quarter. That has been revised from what was before. Recent indicators point to modest first quarter, modest growth in the first quarter. Okay, so that's been changed. I know we can read into that, but let's keep going. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation remains elevated. That's a revision from job gains have picked up in recent months and are running at a robust pace, and the unemployment rate has remained low. Okay, so very, very particular is this statement. They choose their words very, very carefully, and we're seeing what they're choosing to leave in and what to leave out. Reading on, the U.S. banking system is sound and resilient. They kept that one in there, which is interesting. But they took out recent developments are likely to result in tighter credit conditions. So they just started that sentence with tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. So as we could go down the rest of this page, it pretty much gets into the difference in the rate hike, which obviously, is important, but we've already gone through that. The committee anticipates that some additional policy firming may be appropriate. They have foregone that sentence for in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time. So a lot to interpret here as the language has been changed quite a bit. And then the last change here is continuation of that last sentence I was just reading. Additional policy firming may be appropriate. What was completely omitted and not replaced was in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Also omitted in determining the extent of future increases in the target range. Okay, so that has all been omitted and is gone. So that is very interesting to observe. There's no mention of what usually is in there. Let me see if it's in the. There's no mention of like world events. There's usually, mention of like the war in Ukraine, and that type of thing. So we've gotten those in the past. That is completely out. I believe that went out with the last one, but is not coming back here. So that's worthy of note. Even as things slightly escalate today, obviously they couldn't have known that for this statement, but that it was not included here. So any takeaways for you, Piper, from what I just read? Or were
Uh,
you just staring at the ETH charts?
I, I was staring at ETH charts, but I think it's.
Sure.
I really think today he's taken like a neutral, generic run. If it plays out like that, it's going to be very generic and neutral.
Yeah.
I do want to say though that one of the most important comments in here that I've read so far is Oh Man 13 again saying I hate banks unless they buy XRP Army. It's my third
Nice.
largest bag. Let's go with that. Let's get that. Appreciate you all on that. Yeah, so we got about what do we got here? 12 minutes. We got 12 minutes to the speech.
Mm-hmm. That's
Let's
about
go
right.
take a look at the charts and see what's going on the charts. Let's jump in
Let's
here.
do it. Let's do it.
Bam. So I'm gonna pull over here and we'll take a look at these. And then if you want us to go ahead and start pulling up some stocks on your side, just so we can see what the stock market's doing. S&P
Sure.
is starting to get a little pump up here, a little volatility action. We got Ethereum doing a little volatility action. Bitcoin's just kind of grinding right here. I have not seen volatility this low on Bitcoin in a while during the FOMC. Like it's almost like Bitcoin itself is holding its breath, waiting to see what the words of Jerome Powell are. So,
Yeah.
um, I mean, Dixie had a big a drop down, and then it wicked back up almost 50%.
Mm-hmm.
And now it's like right here at this 101.2 range. So it looks like stock markets are actually getting more activity right now in the futures for like S&P. What are you seeing on yours, man?
Yeah, I'm taking a look here at the mega cap tech stocks. They're somewhat unchanged from our last reporting here, even in this stream. Tesla up is leading the mega cap tech stocks up 2.4% there, as you can see on my screen, and then Amazon not too far behind, up 1.5%, and then the rest of your names are green. Meta just barely not green, so you can pretty much say it's on board with getting
Yeah, but
bought, but in this
I'm willing to bet that Meta, if you click on it, it's probably just moved here in like the recent time. Like if you go to like a lower time
yeah.
frame, I bet it just recently pumped.
Yeah, this is a 1 hour time frame, so you can
Okay,
see
yeah.
that today it's had some volatility. It's at the lower edge of its I guess this isn't a day of trading, so this is from the third. Yeah, so it's kind of come down. It had a nice little morning. It sold off around noon and is now kind of trying to rebuild some of those gains, but has come down after making a wick up to $239.82. So Meta,
Sweet.
not the most interesting name right on the street this right now, but there it is, pretty much unchanged on the session. And then yields, continuing to tick a little bit lower as investors are seeking security in treasuries. Um, So that is worth note. And let's see. Yeah, not too much more. I mean, the mid cap tech stocks are mixed. Workhorse had a crazy day yesterday. We can take a look at that with a huge move to the upside there from 80 cents to $1.16 and is continuing to get bought. On the 1 hour, chart prime was giving it some reversal signals there and even a bear E. So that's pretty
That's a
interesting
bearish
there.
engulfing candle there, T-Shroom.
Yeah. Yep.
Yeah.
Absolutely. Well, I knew that, of course.
I was
And
letting
then you're
people
also
know out there though. So
no, I appreciate it. And then C3.ai getting bought a little bit this morning. Again, this is an hourly chart. Man, it's had some volatility as well. So on the stock side, big banks looks like generally are getting bought here. That's just behind my head. So let me zoom up a little bit. Yeah. So the big banks generally getting bought, although JP Morgan and Goldman Sachs, kind of the biggies, are down. JP Morgan down almost 1%. They're over there breathing heavy, thinking they're going to have to bail out old Pac West, and that may just be the case. We'll see. Occidental Petroleum down 0.7%, and then the rest of your oil producers are going to be down there. The energy narrative is actually not one we've been talking about too much as I've been kind of hopping around the shows today. Oil is down 4%. Goodness gracious. So this has kind of slipped under my radar. But oil back down to $68 a barrel. Is that? Yeah. Okay. Well,
yeah,
it's on the hourly chart. That's why it looks a little more dramatic. But yeah,
it's
oil has
still
really
dramatic.
slipped. Yeah, it's still dramatic. So oil, kind of the one of the bigger shockers of the day in terms of movement. Energy, why would energy be down? Well, if there's going to be a recession in the second half, there's not going to be as much demand for movement. Not going to be as much demand for economic generation as people save money during a recession to try to at least. So they're not going to be going out and taking that vacation to visit grandma in California as much. So that's going to be the energy story, and obviously that's at the retail side. There's much more demand for oil, and actually, I don't know. I don't know if more people buy oil, if more like retail buys oil than industry. I would imagine industry buys a lot more oil than retail, but I don't know. I don't know the stats
I
on
would
that.
think so. I would think I would think that's the case. So,
Yeah, especially if you add in the military. Goodness gracious.
oh yeah, JP8 baby.
That's right. That's right. Let's see if the CME futures are moved at all. I don't know exactly why they would have, but let's check them out. Let's see. Start with September. Oh, 91% for May. So it's still not 100%. That's
Did
kind
you
of funny.
refresh?
I did. Yeah. Yeah. This is refreshed. So I guess there's still 92. So it's ticking up, but I guess there's still an 8% chance, 7.5% chance that what we saw, that the government, the .gov has been compromised and the true rate hike is yet to be revealed.
Is not a quarter basis point.
Yeah, yeah, that's just a silly little error. And then June has gone up to 88% that we are going to pause. I think that is an increase from this morning. And then in July, I think that is higher. And then September was kind of the big one. That is unchanged. So 48.9% is pretty much what it was this morning. So where we are going to cut rates, the percentage likelihood of that is pretty much unchanged as of the other side of this print that we got at 2 o'clock Eastern Standard Time.
Yeah,
So that is,
I'm just waiting for Meta to, finally bow down and fall back to the backside and admit that MySpace is a much better product. So, um,
wow. Yeah, you tried really hard with that one.
I had MySpace back in the day. I was like one of the last people to get off of it, I think. So,
Mm-hmm.
yeah,
Mm-hmm. Okay.
I refused to move. I refused to move to Facebook. I was like, why? I like MySpace. It works fine.
Yeah.
I'm an old man, dude.
Old man dude.
Old man,
I
dude.
like it. Well, let's see. Let's see. We got about 5 minutes until Big Jerome gets up there and starts yodeling and filling the mountains
Oh,
with echo.
Crux dropped some info here real fast.
Okay.
67.2% industrial for oil, 26.9% residential, 2.8% commercial, 2.5% electric power. That's who buys it. That's not who invests into it. So
Yeah, no, I was asking about the consumption of the actual
Yeah.
underlying
So
commodity.
yeah,
So
67.2 is industrial. Um,
yeah,
and only 26.9%. So almost half, the 50% the amount goes into residential. So
gotcha.
see, look,
Cool.
Spee said I had a killer MySpace page, right? Like you weren't stuck with following the format that Facebook gave you. You had your individuality spread throughout. So,
I
I
love
think
it.
if MySpace was released today, it would be a Web3 application for
Oh yeah,
sure.
of course, of
Absolutely.
course. In fact,
So
that wouldn't necessarily be a bad strategy to buy MySpace and take it into Web3 because it is a known entity. Um, it could be an interesting
let's
strategy.
do it. Let's do it. Me and you, T-Shroom. After our
Yeah,
2025 run on the bull market, we'll take our money and buy
yeah,
MySpace.
yeah. Absolutely. Let's get Jeff Bezos on the phone and see if he wants to make a deal.
Let's do it.
Yeah, but
Did you remove Tom from your friends list? Oh, now we're dating ourselves. Hey, S&P Mini's moving right now, man.
oh yeah.
Yeah, I mean, look at this. It's coming back up. That which
Mm-hmm.
gets wicked gets candlesticked here. So
Hmm.
it's coming back up. Bitcoin still grinding sideways. Ethereum trying to come back up and wick. It wants to be an S&P. And then the Dixie looks like it's getting ready to come up. I'm betting that right around this range right here, which is going to be about 101.40, that this is going to come back down again. Unless Jerome Powell comes out and just pumps the heck out of the market for the
Yeah,
Dixie and wrecks everything else, which is possible. You never know with him. You never know what's coming out of Jerome Powell's mouth. So
yeah. Well, you know what I want to do? We've got about 2 minutes here. Uh, we have never collaborated with him, but I've been on around the blockchain a couple times with Piano Matty B, and I don't know
yes,
if you guys have ever seen Piano Matty B's content, but especially for our loyal followers, it is a real treat. I don't know if you guys have seen Piano Matty B. I'm going to try and pull him up here on the YouTubes to show you guys a little bit of what his
on
channel
the
looks like.
tube of
But
Ubes.
he plays he kind of does what we do on the morning show, but he like plays music uh instead. So it's like here's his channel. Yeah, you can see. So he's kind of doing this and it's pretty funny and he does raps of different things. So just a quick shout out to him. We are not affiliated with him. We've never collaborated with him. I'd like to. I'm not sure if he does collaborations just with his format, but go check it out. It's a lot of fun. Um, and yeah, so I thought I'd tell you guys about that. It's pretty funny, pretty funny
Perfect.
stuff. They put a lot of work into the production of it too, which is kind of cool.
Where is our
Pretty
shot?
cool stuff. So we should be getting pretty close here to Big Jerome hopping on the big speaker
Yes,
and
sir.
beginning his culling of the American fear. We shall see.
Yep, I got it here. You guys let me know if there's any issues with the sound quality coming in, and I will fix it. I promise. So,
Okay.
um, yes, let me get this on the spy down here. On the spy, where are you, spy?
Yeah. Gold wicked up uh, and has since come back down. It wicked all the way up to 2036. Goodness gracious. And then
Goodness,
it's
here we
come back
go.
down.
Yeah,
Okay.
guys, let me know if there's any problem hearing the sound.
Hmm. Well, there won't be any sound until he comes out of that door.
Yep,
That's for sure. So we
for
won't know
sure.
exactly, but gold is up. Gold's getting bought. Silver's getting bought a little bit more, up 0.4%. Um, Meta is now decidedly green, up 0.05%. So not by much, but it is green here going into the speech.
I
So
can't wait for
exciting.
Gina. I can't wait for Gina to come on. That's Tom Crown's favorite. He introduced me to her, and now I love watching her ask questions. So here we go.
Yeah. Who does she work for? There's the door. It's opening. He's
It's
approaching the
opening. Here we
stage.
go.
All right, guys, we're going to be quiet for this and just kind of watch.
Good afternoon. Before discussing today's meeting, let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode, and will work to prevent events like these from happening again. As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal.
That's all the way up. I'm going to have to find another source.
Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by a 1/4 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. From the perspective of monetary policy, our focus remains. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we are prepared to do more if greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Gina.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
So, taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation at 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. So the staff's forecast is so. Let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's, so different people in the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
Rachel. Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default? And what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters, for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint, I would just say this. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision yet.
Steve.
Chairman, thank you. Yeah, Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle, that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank which talked about the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about, that I recall anyway, about the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing, and I thought it was a good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think banks themselves are many banks are now are attending to liquidity and taking opportunity now, really since the events of early March, to build liquidity. You asked about the separation principle. Like so many things, it's very useful, but we have found that the monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities, and at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
Mr. Chairman, I'm sorry. I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was, they're pointing out something that they're working on and that they're on the case. That I'm not sure whether they mentioned. I think they did actually. They mentioned that they had taken regulatory action, matter or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank, and there are many other banks that are experiencing these things, and we're on the case.
Thank you.
Go to Victoria.
Hi, Chair Powell. I wanted to ask, obviously, with the recent bank turmoil, we've seen multiple banks buy other banks, and I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry really since interstate banking, and before that even. It goes back more than 30 years. When I was in
Jamie Dimon transferred money to my account to not comment on that.
There are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large size banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things. I think that's a positive thing. Is it a financial? So I would just say, in terms of J.P. Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role, so I really don't have a comment on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So, but do you have any concerns about the fact that they're getting larger in general?
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law is it goes to the least cost bid.
Colby. Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that a tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. When we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving a sufficiently restrictive stance. But I think conceptually, though, we think that interest rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong then, if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way. The assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that are listed in the statement, the obvious factors. That's the way we're going to be thinking about it. That's really all we can do. As I say, it does complicate. We have, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and we'll factor that into our decision making.
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made. That would mean we think we've reached that point, and I just think it's not possible to say that with confidence now. But nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting, and that's we're just going to have to, before we really declare that, I think we're going to have to see data accumulating and make that, as I mentioned, it's an ongoing assessment.
A follow-up on credit, but could you give us a sense of what the SLOOS survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLOOS on May 8th, in line with our usual time frame. And I would just say that the SLOOS is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Let's go to Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last 2 meetings, been seeing the effects of those moves. Why did the committee feel it was necessary to keep moving?
Well, the reason is that again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time. And that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. So we really we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, what you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
As I mentioned, I would just say that this assessment will be an ongoing one. You can't, with economic data, you can't. You've seen take inflation for it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that that a few months of data will persuade you that you've got this right, kind of thing. And we have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably, you can calculate them many different ways, but One way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1-year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what most people would, many people anyway, would assess as the neutral rate. So policy is
You're
tight,
welcome.
and you see that in interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing,
better?
I think you feel like we may not be far off, or possibly even at that level.
Not.
No, it's better. Yeah, that's good.
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation, as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
Would you be okay with a prolonged 3%?
You know what? It's let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process, and I think we're going to need to stay at this for a while.
How does the other side of the mandate, the job side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings.
Yeah, I checked a couple of other sites. Their volumes messed up at his stand.
We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation is running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Matt. Hi, Chair Powell. Matthew Boesler with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really, in the labor market. It's interesting, as we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. It wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now, that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet wages have been moving down. Wage increases have been moving down, and that's a good sign. down to more sustainable levels. So I think it's still possible. I think the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is. I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The committee also noted in March that wage growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures, and then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four, and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in an expansion. So yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say.
Yeah, so there you go, guys. He's just
I've never said
he's answering the same questions over and over and over again. At this point, he's ran it into the ground. We know what his stance is. He is primarily coming out pretty hawkish, in my opinion. I thought that was either no comment, neutrality, or very or some definitely foreshadowing hawkish language there. So, what'd you think, T-Shirt?
I thought it was good. I mean, the markets have not really made a strong move in one direction or the other. The indexes are just barely are green, but modestly green. Energies continued to sell off more. Oil has been hit pretty hard, down 4% as I'm speaking here. And then your mega cap tech stocks doing okay. Nothing crazy. Tesla is up 2%. Your later dated bonds, your 30-year is green. The yield is on the day, and then your 2-year is red, but the 5-year is leading lower on the yields.
But I do like seeing that 2-year come down below 4%. That gives me a little bit of hope. So
it could be good. It could be good. A little hope in TradFi there.
That's right.
Yeah. So Coinbase down 3%. That's kind of interesting. So yeah, that's going to be kind of our coverage there. Overall, he didn't show a lot of cards, I'd say. He didn't really go lean one way or another. I think if you had a gun to my head, he did sound a little bit hawkish when pressed on, kind of, are we going to pause in June in the next rate decision? He didn't give a very solid answer. I'm sure he absolutely knows what the CME futures are predicting. Those CME futures, by the way, have come down slightly from this morning. I believe they were in the 80s. Now they're in 77. So not much of a decline in that, which, to be honest, to me, just kind of reinforces that prediction of a pause in June. But that's going to be it. That's going to be it for us, guys. Piper, did you have anything else before we close out?
Yeah. From market open to the speech currently, the biggest move was 2.4% in Bitcoin. So I said it's usually below 5% move during all of this. The volatility to the top and bottom, very contained. So
absolutely.
Yeah.
Absolutely. Well, make sure you guys tune in tomorrow morning, 9 a.m. Eastern Standard Time. We're going to be breaking down everything that Jerome just said and giving some more insights. Guys, after these hearings, a lot of news comes out. There was already a lot of news kind of up in the run up to this print, to this 2%, 25 basis point hike, and more than likely we will get a release of more news too. throughout the rest of the day and into the morning. So definitely stay tuned and tune in tomorrow morning, 9 a.m. for the Investing Bros. We are one of the top growing YouTube channels in the crypto space, and we are the most generous investment community online. Thank you guys so much for watching. Catch you in the morning.
Later, y'all.